Every 4 years or so, the Bitcoin network undergoes a unique event called the halving that has significant implications for the cryptocurrency supply and market dynamics. The next halving is expected in 2024, and it's generating a lot of buzz and speculation about its potential impacts. But what exactly happens during a halving? And does this pre-programmed supply reduction really influence Bitcoin's price like some claim? Let's dive deeper into this pivotal event. At its core, the halving is a mechanism hard-coded into Bitcoin by its pseudonymous creator Satoshi Nakamoto to control the supply of new Bitcoins entering circulation over time. Here's a step-by-step look at how it works. New Bitcoins are created and awarded to miners for verifying transactions on Bitcoin's decentralized blockchain network. Nakamoto designed Bitcoin to have a finite total supply capped at 21 million coins to mimic the controlled supply of precious metals like gold. To gradually reach that cap, the Bitcoin protocol includes a rule that cuts in half the amount of new Bitcoins awarded to miners every 210,000 blocks, roughly every 4 years. This halving of miner rewards slows down the rate at which new Bitcoins enter the supply over successive halvings until the final Bitcoins are released around 2140. For example, when Bitcoin first launched in 2009, miners received 50 new Bitcoins for each block mined. After the first halving in 2012, that reward was cut to 25 Bitcoins. The next halving in 2016 decreased it to 12.5 Bitcoins per block. And in 2024, miner rewards will be cut again from 6.25 to 3.125 Bitcoins. While the supply-focused mechanics are clear, there's heated debate around whether and how the halving could impact Bitcoin's price. Scarcity narrative. Some investors believe that by reducing the rate of new supply coming onto the market, the halving effectively makes Bitcoin more scarce over time. Following basic economic theory, they argue this planned supply squeeze should increase Bitcoin's price, akin to a commodity like gold becoming more valued as it becomes more rare. However, critics contend there are flaws with this scarcity-driven price thesis. The halving and its supply impacts are openly pre-announced events that should already be priced into the efficient Bitcoin market well in advance. Mining profitability declines post-halving, which could force some miners to sell more Bitcoin reserves to remain operational, adding downward price pressure. Bitcoin is unlike physical commodities where supply deficits are more disruptive and permanent scarcity is truly limited. Looking at previous halvings gives a mixed picture on whether the events reliably catalyze price rallies or apply sustained upward pressure. 2012 halving. Bitcoin initially rose over 50% in the 4 weeks after, but then fell sharply amid broader market turbulence and skepticism. 2016 halving. Bitcoin rose a modest 1.3% in the week after this halving before dropping, then surging over 300% months later as adoption increased. 2020 halving. Bitcoin rallied 12% in the following week and over 650% over the next 12 months. However, other factors like money printing and pandemic trading were also cited as catalysts. While undoubtedly a unique event that impacts Bitcoin's supply rate, it remains fiercely debated whether the halving alone is enough to drive sustained price appreciation for Bitcoin. Like past events, the upcoming halving's price impact may depend on variables like market sentiment, regulatory developments, and potential shifts in mining behavior and profitability. As cryptocurrency markets continue their evolution, watching how this programmed deflation event impacts prices and market forces will be fascinating. But whether the halving lives up to the immense hype this time remains to be seen.